Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the financial jungle and find the hidden gems or the shiny red flags. Today, we're diving into a report from the Federal Home Loan Bank of Dallas, or FHLB Dallas as they like to be called. They've just dropped some filings that shed light on their operations, and let me tell you, it's not like your typical company earnings report. It's more about the nitty-gritty of how they raise and manage their funding. Stick around because we're going to unpack what this means for them and for anyone who might be watching before we dive in. If you like getting straightforward insights from these complex corporate documents, make sure you've hit that subscribe button. And if you want to join a community of like-minded folks dissecting these filings, our Discord channel link is in the description below. It is a great place to share your thoughts and learn together. Alright, so what we're looking at here is a report that touches on the creation of financial obligations, which is essentially how the FHLB Dallas secures the money it needs to operate. Now, FHLB Dallas, like other banks in its system, gets most of its funds by selling what they call consolidated obligations. Think of these as big loans that FHLB Dallas and other similar banks collectively promise to pay back. These aren't guaranteed by the US government, mind you, so it's important to remember who's backing these debts. The FHLB Dallas serves a specific region, and it's a federally chartered corporation. They've got a history in this area, and today's report is about recent commitments to issue these consolidated obligation bonds. It is a way for them to make sure they have the cash on hand for their operations and to lend out to their members, which are typically financial institutions like banks and credit unions. Now, let's get to what is really interesting, the actual deals. This table here, Schedule A, is where we see the specific bonds they are committing to issue. We're talking about some significant sums of money here. For instance, on the 1st of December, they committed to issuing a bond with a par amount of $10 million until December 2055. That is a long way out. Folks, 30 years, and the interest rate on that one is fixed at 5.200%. Then, just a day later, on the 2nd of December, we see a few more. To raise another commitment for a $10 million bond maturing in 2055, this time with a slightly different call feature. Remember, these are callable bonds, meaning the bank can choose to repay them early under certain conditions. The styles of these calls matter. We have Bermudan and American call styles. Bermudan means they can call it back on specific dates, like a recurring appointment. American means they can call it back any time after a certain date. And on that same the 2nd of December, a significant $30 million commitment is broken down into two separate bonds. One is for $15 million due in 2035, carrying a 5.000% fixed rate. The other, also $15 million, matures in 2032 and has a 3.935% fixed rate. Notice how shorter maturity dates can sometimes have lower rates. Finally, on that busy the 2nd of December, there is another $20 million bond committed for issuance, set to mature in 2055. This one's got a coupon rate of 5.250%. So in just a couple of days around December of 2025, we're looking at a total of approximately $70 million in bonds being committed for issuance. That's a substantial amount of money being raised. These bonds, as noted in the filing, often have what's called optional principal redemption. This means FHLB Dallas has the flexibility to pay back the principal early. Why would a bank do that? Well, if interest rates drop significantly after they issue a bond, they might want to buy back those higher interest bonds and issue new ones at a lower rate, saving themselves money in the long run. It's a classic move in debt management. And what kind of rates are we talking about here? Largely, we're seeing fixed rates, meaning the interest payment stays the same throughout the life of the bond. This offers predictability for both the issuer and the investor. It is a stable way to manage borrowing costs. Now, as with any official filing, we have the signatures. This confirms that the right people have reviewed and approved this information. Katie Watson, Vice President and Director of Financial Reporting, has signed off, and this report was dated the 4th of December 2025. Number analysis and conclusion. So, what is the big picture here for FHLB Dallas? This report shows they are actively managing their funding by issuing new debt. The amounts are significant and the maturities stretch decades into the future. This strategy allows them to secure long-term funding, which is crucial for their operational stability and their ability to support their member institutions. The fixed rates on these bonds suggest FHLB Dallas is either anticipating stable or rising interest rates, or they simply prefer the certainty that fixed payments provide. The inclusion of callable features gives them flexibility to refinance if market conditions become favorable for them. However, it's important to remember what the report explicitly states. These consolidated obligations are not guaranteed by the US government. While FHLB Dallas is a well-established institution, Its financial health relies on its own resources and the collective strength of the FHL banks. Anyone investing in or relying on these bonds should understand that risk. Looking ahead, FHLB Dallas will continue to manage its debt portfolio. The key will be how effectively it can manage these interest rate risks, especially in a changing economic environment. If rates go up significantly, their existing fixed rate debt will look good. If rates fall unexpectedly, their flexibility with callable bonds will be tested. For now, they appear to be executing a standard, albeit large-scale, debt issuance strategy. Alright, that is our breakdown of the Federal Home Loan Bank of Dallas recent obligations filing. What is your take on these numbers and what they signal for the company's future? Do you think managing funding through consolidated obligations is a smart move? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps us out. And subscribe for more deep dives into corporate finance. Don't forget to check out the Discord link in the description below to join the conversation. Thanks for watching, and we'll see you next time on Corporate Decoder.